Hey everyone, this is Scott here again with a new video to help you learn how to trade, invest, and master your finances so you can apply that knowledge in the real world and multiply your money. And in today's video, I'll be taking a deep dive into the VIX Index and explaining exactly what it is and also why it is so important for everyday traders and investors to both understand and follow it. And if that sounds interesting to you, then please do me a favor and hit the like button on this video and subscribe to my channel. It would really help me out a lot. And so, as always, before getting started here, if you would like to take some in-depth classes on options trading, and stock market investing, then please check out my courses on SKILLSHARE. I've been teaching on that platform for over a year at this point, and in case you aren't aware, SKILLSHARE is a lot like YouTube, except the content on that platform is geared solely towards the purpose of education in the form of online classes. And in my classes, you will see a lot of the detailed research and analysis that I've done using real stock market data, spreadsheets, graphs, and even computer programs that I have written to help simulate and prove the concepts that I am teaching. And I've dropped some links to some of the more introductory courses of mine in the description of this video below. Now, you will need a premium membership with the SKILLSHARE platform if you do want to watch my courses. But if you do sign up for that membership using the links provided in the description of this video, you'll get an absolutely free 2-week trial. And during that time, you can watch all my courses on SKILLSHARE for free. And then once your trial is over, it's only going to cost you a few dollars a month to maintain your membership, and you'll gain access to all the future courses that I have planned going forward, in addition to all the other classes that are on SKILLSHARE too. And if you decide it's not for you, no worries, you can cancel before your trial is over and you won't lose a dime. But again, if you are interested, then please check out those links below and join the thousands of other students that have already taken my classes. And so with that being said, we're going to jump over to my trading platform now and we'll get things started. All right, welcome to my ThinkOrSwim trading platform here. And what you're seeing is a 1-year price action chart of the VIX, which you can get to in any trading platform just by typing in VIX. That is the ticker symbol for this particular index. And so like I just said, the VIX here is an index, meaning it is simply a measurement tool of sorts that shows you the current level of implied volatility in the market. Now, there's a few things there that I need to unpack. And we'll start off first by talking about implied volatility. And simply speaking, implied volatility is just the market's expectation of where a particular stock or ETF will be at some point in the future. It basically gives you an expected price range of where that stock or ETF will be either a year from now, a month from now, a week from now, a day from now, etc. You can use implied volatility for any particular time frame in the future. So for example, if I come over here and go to the SPX, this is another index that tracks the S&P 500. And so of course, because this is a different index, this is also just a measurement tool that essentially aggregates together the performance or the value of the top 500 companies in the US. And I would imagine that most people watching this video have at least heard of the S&P 500 or the Dow Jones or the NASDAQ. These are all just different indexes, different measurement tools that you can use to get a gauge on how the stock market is currently performing. And so down here specifically in this chart, and I'll actually expand it a bit so it's easier to see. There we go. So this is a 1-year chart of the implied volatility for the S&P 500, for the SPX here. And you can see as of right now, the implied volatility is 22.27%. You always read this as a percentage. And moreover, this is going to be quoted on a 1-year basis in the future. So now tying this all together, if the implied volatility for the SPX is currently 22.27%, this means as of right now, the entire market is basically expecting the S&P 500 1 year from today to either be up or down by 22.27%. Right? Like I said, it's simply an expected range, either an up or down movement at some point in the future. That's it. Now if you look at this graph, however, you will notice that it definitely fluctuates. The implied volatility right now is on the lower end, 22%, but if you go back to February and March of 2020, when the coronavirus pandemic shock was scaring everyone, the implied volatility got up to over 80%. Right? So again, that means a year from this point, the market was expecting the S&P 500 to be either up or down by around 80%. That's a massive, massive number. And so now if you just take a good look at this chart down here, and then I come back to the VIX index, you should notice it has a very similar shape. And that's because this is the exact same thing as what you see, going back to the SPX one more time, it's the exact same thing as what you see down here, right? The VIX is simply an index that tracks the implied volatility for the S&P 500. And so of course, as you can see right now, the current level of the VIX is right around 22%. And so now at this point, you can basically ignore the graph down here. Since we're already looking at the VIX, we're already looking at the implied volatility for the S&P 500. That means this graph down here is showing you the implied volatility of implied volatility. That's a more complex topic, and I'll make a video on that separately in the future. So really, I just want to direct your attention to this graph right here, the implied volatility of the S&P 500. And so the next thing I want to talk about here is, where does this stuff actually come from? How can we even measure the implied volatility, the market's expectation of where a stock or an index will be in the future? And the answer to that is, it simply comes from the prices of the options. So if we go to the trade tab here, and if I go back to the SPX, this is the option chain for the S&P 500 index. So for example, if you look at the March expiration options and unfold this tab here, right, here are all the call options, here are all the put options for the SPX index that expire on March 19th. And so how this works on a high level is, option pricing, the way you actually price an option is you need the implied volatility for whichever stock or index or ETF that you're currently looking at. So when the markets are open and trading is currently happening in these option markets here, depending on what the market at this point in time is expecting the S&P 500 to be at some point in the future, the prices of these options are going to reflect that. So what the VIX Index is it's basically looking at the prices of these options, and it's backing out, it's mathematically factoring out the implied volatility from these options. I will not go any more in depth other than just to say that. I just want you to have some awareness of where this stuff comes from. It simply comes from the options on the SPX index. So let's come back to the VIX now one more time. And so now, why is this even important to understand or to even follow on a pretty frequent basis? Right? For example, I look at this stuff every single day when the market opens. And that's because the VIX implied volatility is simply the market's fear indicator, right? Because just think about this conceptually. When implied volatility goes up, when the VIX goes up, that means at this point in time, the market is now expecting a year from now the S&P 500 to be either up or down by a much greater amount, right? At this point in time, the VIX was at 40%. So 1 year from this point, the market was basically expecting the possibility of the S&P 500 to be down by 40%. That's basically a market crash. And then of course, as I've already mentioned, at this point in time, the market was expecting the S&P 500 to potentially be down a year from this point by 85%, which is not that far from the S&P 500 going to zero. So obviously there was a ton of fear at this point. Like I mentioned, this is right when the coronavirus pandemic fear was really exploding, and no one knew what was going on or how COVID was going to impact the economy and social life and things like that. It was just pure panic and mayhem. And so of course that gets reflected, this fear gets reflected by the VIX index. So using this index is a great way to get an idea or a gauge on the overall sentiment in the market. Are people generally content and happy at the moment? Is the market just slowly grinding higher and everything seems fine? Or is there a pop in fear and panic for whatever reason, and is the market about to get chaotic and crazy because of that? And that's the very key thing to keep in mind here. The VIX index can be used to indicate whether or not the market is about to get a lot more volatile and chaotic and potentially go down significantly. For example, let's go back to the SPX index and let's look at this big down move right here. From top to bottom here, this was about 10% or so. And so if I zoom in here just a little bit, you can see leading up to this big down move, everything seemed fine. The market was slowly grinding higher. And taking a look at the dates down here, right, this up move here was happening in between late August and early September of 2020. So now let's go back to the VIX index here and take a look at the VIX during the same time frame. So once again, I'll zoom in a bit here. And so going back to late August, at this point down here, the VIX was pretty flat, very low, indicating that at this point in time, there was not a lot of fear, not a lot of panic in the market. But you'll notice soon after, the VIX started to increase, right? Basically starting on August 26th, and from that point on, the VIX started to increase almost every single day until it had this huge pop on September 3rd. So let's go back to the SPX one more time. Zooming in again. And now let's take a look at September 3rd, which is this bar right here. So this is the date where the market had the very first huge down move. And so of course when this happened, a lot of traders and investors freaked out, which caused a lot more panic and fear to enter the market. And that's why you saw on this day the VIX had that huge pop. But look at the days previous. The days previous on the SPX seemed totally normal. The market was just slowly grinding higher. Nothing to fear on this chart. But as you just saw with the VIX, the previous week or so leading up to this point, you saw the VIX expanding and rising. And in fact, coming back down to this chart right here, right, like I said, this is simply the VIX Index down here. And so September 3rd is right there. This was the peak of the fear and panic when this down move occurred. But like I was saying, the previous week or so leading up to this point, you saw an increase in implied volatility. The VIX was expanding. And so it's moments like this when if you were to just look at the market and the market is just grinding higher, nothing is going on that would seem to indicate panic or fear. But behind the scenes, however, when you look at the implied volatility for the S&P 500, or for any stock for that matter, you may very well come across moments just like this, where the final few days leading up to a big move, you see an increase in implied volatility. And so this is your warning sign that something pretty significant is about to happen. And as a result, you might need to prepare yourself or prepare your account in any way that you see fit for this potentially very large event. Now, the VIX is not always going to be able to warn you when something is about to happen, right? For example, the actual crash that occurred last March, which was way back over here, this came pretty much out of nowhere, right? For example, if I go to a longer term chart, let's look at the 5-year, 1-day chart, and I'll zoom in a bit here. So as of right here, this was the peak before the market totally crashed. And if you look at the implied volatility at this point in time, the VIX essentially, it showed almost no indication that something was about to happen. And then right when the market started to crash, at that point in time, then the VIX, then implied volatility basically exploded. So like I said, the VIX is not going to be able to warn you every single time that something is about to happen. No one predicted a global pandemic to occur. This was a total black swan event, as they call it. It's a catastrophic event that comes out of seemingly nowhere that no one saw coming and that no one predicted. For those kinds of events, the VIX is not going to be able to warn you. But of course, the VIX is overall still a very useful thing to look at on a frequent basis. Because even though it might not warn you about every single big event that's about to occur, it can definitely warn you about a lot of them. And I would of course rather be prepared for as many big moves as possible so that I can adjust my account and my trades accordingly than to just have no insight into what's about to happen and simply have to face every big down move or every big move period totally blind. So I hope this stuff made sense. I know the VIX and implied volatility and all that is a bit more complicated. So of course, if you have questions or if you need clarification on something, please do post a comment on this video and I'll get back to you as soon as I can. And so that concludes this video. I hope you enjoyed it and let me know in the comments what you think about all this. Were you already somewhat aware of what the VIX was, or is this all brand new stuff for you? Let me know. And don't forget, if you want to take some in-depth classes on options trading, and stock market investing, then check out my SKILLSHARE courses, links in the description of this video. And lastly, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. And make sure those notifications are turned on. I'll be dropping new videos every Monday, Wednesday, and Friday, and you don't want to miss out. So thanks again for watching, and I'll see you next time.